We're going to step back and take a look at the past, especially how crypto market structures and liquidity have changed greatly since 2008 when Bitcoin's white paper was released. This panel is going to focus mostly on yields and liquidity, but cover a lot of stuff. Here to talk about it, we have Hanson Birringer, Colton Conley, Ryan Demattia, Nico Katsafanas, and the chat will be moderated by Geoffrey Greenfader. Hanson is the Vice President of Institutional Sales at Genesis, which is the global leader in institutional digital asset markets. Colton is the founder and CEO of Prime Protocol, which is building the first natively cross-chain prime brokerage. Ryan is the founder and managing director at Coindex Capital, and Nico is a senior trader at Edge Capital Management, which is an investment group specializing in digital assets and DeFi protocols. Jeff is the head of business operations at DMA Labs, which is working on building the next generation of decentralized finance. These guys obviously have some very impressive resumes, so let's give our attention and welcome them to the stage.
Hey all, good morning. Thanks for joining us here today. My name is Geoffrey, and I'm a proud GT alum, so it's just great to be back here in the house. Shout out to 404 DAO for putting up an incredible conference for us all. Just real excited to share an incredibly interesting and incredibly complex topic with you guys today, and I'm accompanied by four incredibly bright gentlemen who are very eager to share their take on the evolution of capital markets and liquidity. So I'd like to just do a little brief introduction, starting over with Hanson. I know we kind of just hit one high level, but I'd like to hear some intros from the gentlemen themselves.
Good morning. Nice to meet you, everyone. My name is Hanson Birringer. I sit on the sales team at Genesis Trading. We are a crypto prime broker, been around since 2013. Servicing institutions looking to buy, trade, and hedge, and also custody digital assets.
Good morning. I'm Nico Katsafanas, senior trader at Edge Capital. Edge is a market-neutral fund within the crypto sphere. We consider our strategy to be both on-chain and off-chain, combining traditional finance macro strategies with the current DeFi landscape.
Hey everyone, my name is Colton Conley. I'm the founder of Prime Protocol. We're a cross-chain decentralized prime brokerage, so we provide spot liquidity based on collateral you can deposit on any EVM blockchain, and everything is cross-margined. So it's like a DeFi protocol, but one account across multiple chains.
Hey guys, I'm Ryan Demattia, founder and managing director of Coindex Capital. We have 3 different DeFi hedge funds. They're all market neutral, but focused on deploying liquidity on-chain and generating yield, and doing so in a market neutral capacity.
Awesome. All right. Well, thanks for the intro, guys. So let's just kind of start with a little easy layup question. Let's just kind of set the stage for what we're about to talk about today. So how do decentralized finance, otherwise known as DeFi, and traditional finance, also known as TradFi, how do they differ? Hanson, if you don't mind kind of leading us off here.
Yeah, I think the biggest thing to take that into account would be the nature of the assets that you're trading. So crypto is inherently a bearer asset. I think a lot of companies like myself and what Colton's building, we're trying to solve for that cross-margin capability that you find very common in TradFi. You can have a position on through your prime broker like Morgan Stanley, Goldman Sachs, and all your positions are cross-margins because it's really one centralized database. In crypto, that's kind of the opposite, which is both a feature and a bug, some might say. So Bitcoin has to be on one exchange for you to trade it. It can't be on a different one. You actually have to send it from one location to the other. So I think that's probably the biggest difference between the two market structures and the different asset classes.
Awesome. Colton, you want to chime in?
Yeah, I would say like in traditional finance, one of the big differences is there's trust involved. And so what that means is, if you're a big hedge fund, like I used to work at Citadel, and we could go to our prime broker and get really great rates because they're like, well, you're Citadel. We know that you guys are going to be able to meet the margin requirements. We know you're smart. You're going to hedge your book. So we're going to lend you a lot of money under collateralized, and give you a low rate on it. With DeFi, there's no trust involved. So what that means is, you could be anonymous, you're just a wallet address, and the cool thing about DeFi is you don't need to trust that the other participant is going to pay you back, because you can lock up their tokens in a smart contract and have on-chain logic, and all of the rules are transparent and available for everybody to see. One of the drawbacks that this has led to, which is what we're trying to solve for at Prime, is this creates inefficiencies that didn't exist in the TradFi system, because with traditional finance, you basically get more leverage for the same amount of collateral than you would get in DeFi, because you have that trust that's giving you, extra ability to take out that margin. And right now in crypto, everything's sort of like a siloed island. Each protocol is separate, and each chain is very separated from each other.
Awesome, thanks for that. That's get three different takes here, but I do think that the fundamental difference is that it's a trustless system where the technology itself governs transactions, and I think that that's just the beauty of the industry. So many in the industry say that liquidity is the lifeblood of crypto, but why is liquidity so important? What does that really mean?
Yeah, I mean, if you zoom out a little bit, liquidity is the lifeblood of literally every market, traditional markets and decentralized markets, right? And when we think about things like the global financial crisis, bond markets in 2019, all of these major events tied up with some instance of illiquidity or lack of liquidity. Anytime you have illiquidity, you basically have systemic risk where things can unwind really quickly, and people can't actually get kind of this nice fluid in and out that actually lubricates markets and makes them efficient and functional. So I don't think it's unique to DeFi in any way. I think it's just really the way markets work is they need liquidity to function effectively. Healthy markets are healthy because they're liquid and they're efficient. And so when they're not those things, whether it's DeFi or TradFi, you have issues, and you can break a buck, whether it's UST or a centralized money market.
Yeah, I think on the liquidity side, where we really see it matter so much in DeFi would be, over the past several months, we've seen liquidity kind of go away. Obviously, as prices have become depressed, and a lot of the protocols that we all use were designed with a high liquidity environment in mind. This is a problem when you get in these low liquidity scenarios, when you take a look at case studies like Mango markets most recently, or if you look back at Rari's Fuse lending markets, where you have illiquid collateral that can be manipulated very easily simply just by purchasing it up, artificially inflating that value, and then borrowing against it. And then you have instances of bad debt as a result. It's happened on Venus, on Binance Chain several times, obviously Rari, and then Mango is the most recent, and we've had to see protocols take steps to avoid these. Aave recently pausing the more illiquid markets on the borrow side and on the supply side. So it definitely impacts us quite a bit as market neutral managers, but liquidity definitely remains king.
Yeah, so obviously a lot of current events being thrown around here, and things that we've all kind of either seen transpire or have actually, we've been affected by some of these adverse effects over the past summer. But before we dive into some of these, let's take a step back and talk a little bit about, if you're a crypto project or you're a crypto protocol and you want to get going, you need to bootstrap liquidity. You need to cover operating expenses like salaries, gas fees, paying for your devs. All these things need to be paid for. So one of the biggest challenges is bootstrapping liquidity. So, what happens is what I've seen happen sometimes is projects will often sell their tokens for stable assets. So do you guys think that this is, to begin with, a healthy just way to go about funding your projects? And have you guys seen any alternate methods? I'd kind of love to explore this topic for a little bit. Colton, if you want to lead us off here.
Sure. So I think especially at the early stage, unless you already have a ton of money to fund the entire project yourself, you're going to have to sell either equity or tokens to investors in order to get your project going. I think probably what we saw at the peak of the bull market was an excess of giving away your tokens for people to basically put money into your protocol and you'd rent liquidity. So I think there's a big distinction between, are you using this money to build something, or are you using this money to pump your numbers and make your protocol look better? And then as soon as the market goes into a downturn, all of those tokens you spent were for naught because everybody pulls their money out of the protocol and you got no lasting benefit from that. So I think there's a balance that needs to be struck between using incentives intelligently, initially to raise funding, and then also to get people to start using your protocol sort of at its genesis. But you need to make sure that those incentives are sustainable and there's a path to profitability where you can taper those off and not continue to rely on these token incentives that I think for a lot of DeFi protocols masked a lack of product market fit, because there were a lot of copy-paste protocols where the only thing they were doing new was offering more incentives than the next guy who they just copied the code from. And that's not creating value. That's like a Ponzi scheme. And I think you're noticing a lot of those projects are going to get washed out.
Let's dive in a little bit more into that right there. So where is this coming from? Where are these tokens being thrown out from? And is this, a necessary evil, or is this just a completely unsustainable method that's going to be corrected one way or another?
Well, like I said, I think token incentives at the beginning of a protocol can be appropriate because you need to get people into the protocol, because I've heard a lot of my investors and other people in the community throw around like TVL begets more TVL, which is true. You need a starting place to get your protocol off the ground. But if you didn't build something new and there's no reason for people to stick around and actually use your protocol because it's not doing something useful that other people aren't offering them, they're only there for the incentives. And no matter how many incentives you throw at them, as soon as you turn that off or you run out, they're going to leave. So I think it really depends on, are you building something new and innovative, or are you copying somebody else and trying to make a quick buck by building hype and then dumping on people?
So I think this is a great segue to kind of discussing the current events that have transpired over the past several months, particularly the DeFi summer that we all just kind of experienced. Hanson, if you kind of want to talk to us a little bit about what you've seen and what went wrong with this liquidity crisis that we saw at a high level, and then we can dive in and nitpick some of the parts there.
Yeah, absolutely. So I think this past summer, obviously the industry went through a lot of different credit events. Certainly some large counterparties in the space. Obviously 3 Arrows is kind of the elephant in the room here. The kind of aftermath of that, particularly from firms such as Genesis that kind of sit in this like CeFi, DeFi world, really analyzing our risk framework and underwriting process for counterparties, getting a deeper understanding of second order effects of exposure, which I think we're now also starting to see in the mining segment as well. You have kind of one domino falling, and then it impacts other players. But kind of tying things back to the liquidity overall structure in the market right now, we're seeing TradFi rates have escalated, and the risks that you're taking on when you're going out in DeFi maybe aren't warranted so much anymore. And so I think, as Colton was saying, the incentives need to be aligned to attract users, but to really keep them there, there's always an opportunity cost of that capital when you're going out into DeFi, especially now with attractive rates that you're seeing in CeFi. So I think I just wanted to kind of throw that out there as well, just like something that we're seeing, particularly on the dollar demand side from our counterparts.
That's a great point. Nico, can you share a little bit about how maybe your fund has shifted strategies, or just different ways that your fund has shifted its perspective on the macro level?
Yeah, definitely. So obviously yields have compressed quite a bit, and as Hanson alluded to, when your risk-free rate on T-bills is somewhere between 3 and 5%, why am I going to go to Aave and earn 50 bips on cash when I'm taking smart contract risk, Oracle risk, and just a myriad of other dark forest, as we call them, risks? So we've had to get creative in a lot of ways. So shifting to not only on-chain yield farming, but doing things like TradFi, DeFi arbitrage. There's a lot of inefficiencies that exist there. In addition to just getting more creative on the VAR side as well. I think that's super important for us. But overall, market neutral within crypto. If you look at 2019 to 2021, you were seeing funds print anywhere from 25 to 40% net returns year over year, market neutral, which is ridiculous, frankly. So we were kind of due for this pullback, but as token prices kind of bounce back, you will see yield farming return a bit. But in terms of pure stablecoin yield farming, it's, again, you're looking at 5% on solid stables. If you want to go way out on the risk curve, you can go to USDD, the Tron stable, but you're getting paid 17% to just take pre-Luna risk, essentially. Like it's an unsustainable system. So it will break eventually if it gets big enough. So you really gotta do quite a bit of risk mitigation to keep your fund afloat, avoiding things like bridges. I've seen 3 market neutral funds this year alone blow up as a result of bridge hacks, right? And is it really worth 5% to blow up your whole fund? Probably not, right? So got to avoid that kind of stuff.
Yeah, you definitely bring up an interesting point. Sustainable yield, real yield. These are all terms that I've heard floating around the industry quite a bit. Ryan, if you'd love to kind of share with us what you're seeing, what you're hearing, what makes sustainable yield, what makes real yield, and how will this carry over into the next bull run?
Yeah, no, thank you. And, to Nico's point, one of the things that's been really interesting over the last year or two has just been this shift from, whatever yield you can get to real yields. And so I think it's important to keep in mind kind of the context of where you're earning those yields as well. Like last year, you're earning maybe a 20% yield, but 15 to 17% of it is earned in what we like to call Cracker Jack stickers, because you're not getting paid in real hard money. You're getting some protocols token that you have to then turn around and find a market to try to sell it in. And they're also inflating it literally faster than you can sell it. And we're doing this, if you zoom all the way out, in an environment where the US government is printing dollars faster than they ever were in history. So last year, all right, I'm making 28% annualized, but in real terms, I'm probably only making like 10, especially when I look at that Cracker Jack sticker that is down 97% year over year. And so like everyone is woken up to that. We all know that you can't just go to sleep and get 20%, because in DeFi, you get paid to take risk. The more you get paid, the more risk you are taking. And so I think like with real yields, people are understanding, okay, I'm willing to get paid less because I understand the type of risk that I'm taking when I go get that yield. And it's actually coming from real market operations, right? Like Uniswap's model is so straightforward. It's like 3 sentences, right? They charge a fee, and as a liquidity provider, you get a piece of that fee. You don't need, a math PhD. You don't need to understand game theory to figure out whether or not you're going to get paid. And so that's kind of the really simple sense of real yields. But we're now getting this risk curve to real yields that is kind of mimicking what we saw last year, just without so much of the black box. Because if you want to push it and say, get out of single digit yields into double digit, 20, 25% plus, you can do that now in real yield terms. And it looks like decentralized options vaults, where it's like, okay, again, what's really important about this is, sure, I'm locking up for a 20% yield, but it's not just the anchor black box, right? There is an underlying cash covered option strategy that makes sense, where it's like, all right, I know my risk. I have a strike price where I might get blown out on the trade. But again, like I can actually underwrite and price the risk I'm taking. Whereas like Anchor was a 0 or 1 black box risk. And like you're taking the option to risk 100 to make 20, and that's never a good trade. So yeah, that's kind of how I like to think about real yield.
I would push back a little bit on the real yield. I think it's a bit of a misnomer in a lot of cases. So I think the best example of real yield would be like GMX is kind of where people have talked about real sustainable yield. It's trading fees, right, at the end of the day. So as trading fees trend down on these dexes, that yield sustainability goes away, right? We've seen Coinbase volumes down, 85% from their highs, things like that. So you are earning trading fees, but people have this idea that real yield is much safer, when in reality, you're taking on a much different risk profile, doing things like providing GLP liquidity. You've massive IL risk, but on top of that, you are taking the other side of trades. So if there's a bug in the execution contract, or as we saw with the manipulation that occurred with GLP and folks being able to manipulate AVAX, you can kind of get wrecked on that side. So I think there needs to be a lot more transparency in how real yield is generated, but overall, I think it is a better model than the pool 2 900,000% inflation model.
Yeah, no doubt. So just right back at you, this is a hot topic right now, and it's being floated around in many different conversations. We actually were discussing this a little bit briefly can regulation help this? Can regulation help yield transparency and ultimately take this DeFi component to the next level?
Yeah, so it's I'll let you jump in here too, but I think being crypto native, we're anti-reg kind of as a baseline assumption, but at the same time, somebody's going to step in and regulate things, and it likely will get better. But the downside of that is a lot of DeFi yield is the result of inefficiency. So as it gets regulated, it gets more efficient, and then yields will compress kind of as a result, is kind of how we see it going. But rehypothecating traditional collateral in a regulated environment on DeFi, very, very compelling use case. So double-edged sword there.
Yeah, I mean, my thought about transparency here is like you really need to draw the distinction between CeFi and DeFi, because DeFi is already fully transparent, right? Like it's 100% transparent, it's on chain, and everything that blew up between May and June essentially did through instruments of opacity or off-chain components somewhere that centralized the risk and required some sort of trusted element. So it's always really funny to me when like traditional markets and traditional participants want to see more transparency in DeFi, because the irony is it's a level of transparency that centralized entities are not held to. Like if I wanted to go lend to BlockFi or to any of the centralized folks that took a lot of risk and ultimately hurt themselves, I'm not getting any of the transparency that I don't get to see their entire book. But I can literally go look at Aave and understand the structure of all of their markets, understand how that liquidity is composed, how decentralized it is. And so I think like you really need to draw that distinction between transparency that like, I'd love to see a lot more transparency around Binance and FTX and how they generate their yields, as opposed to like the on-chain yields that you can get in DeFi.
Can I just add one thing there as well? So I think like when you're talking about regulation, you actually have to look at what's being proposed, what bills are in Congress, and what is the SEC and CFTC doing about it. And objectively, everything that's been proposed is terrible for DeFi. Like there's nothing that's been proposed that would be a net positive. You have the Waters-McHenry stablecoin bill, which wants to ban all stablecoins and basically force everybody to become a CBDC. They're in talks to try and adjust things to maybe have a carve out for over collateralized stables, but like Maxine Waters just wants to kill everything. And then if you look at like the DCCPA right now, that's just like FTX going in and trying to squash DeFi to move everything to centralized exchanges to push their agenda. And if you look at what the SEC has been doing, they won't even give people clarity. Like nobody knows what the regulations are until you have a lawsuit against you. And so like, fortunately, Ripple's been fighting back against that. But frankly, like all regulation that has been proposed is bad regulation. It's more of a question of like, what regulation is worse than others? And I think the question was more of like, is this going to improve real yield and trust? And the thing is like, DeFi is already completely transparent. You can already see you can see the code, the rules, and what you're playing by. And if you get into that, like ultimately that's on you. What the regulators seem more interested in doing, and in particular this administration, is just squashing innovation because they don't have control over it. And ultimately, I think that once you get regulators involved, it's more of a struggle for control over your pocketbook rather than trying to protect you.
Yeah, I think you brought up a really good point there. People kind of agree to a social contract when they step into DeFi. There is a need to protect your uninformed kind of retail segment to a degree, but we all kind of signed up for the same thing. We understand that the code is in beta. You typically click, I agree to the terms of services when you walk in saying this is unaudited, brand new code that's been operating for a year, right? You wouldn't walk into that with your life savings typically. So I think the regs are important, but as you mentioned, there's ulterior motives there that are pushing it the wrong direction.
So obviously a very passionate group of people here, and we're lots of strong opinions. And I think the one big component, at least the reason why I was really excited by DeFi when I first started in this space, was because I truly believe that DeFi is freedom. And I think that the moment that people are able to understand the powers and understand the risks, balance the two, and make a good informed decision, I think it empowers everybody. It empowers people different countries, different borders. It becomes a borderless system, and I think it unifies and brings people together. And ultimately, that's what excites me the most about this space. And so, there has to be some sort of change where we can bring in the mass consumerism and foster this this system and make it something that's usable for all. And I feel like at this point in time, it's not at that state. So I'd love to kind of hear what your guys' thoughts are on how we bring DeFi to the masses in a safe, sustainable way. Hanson, if you want to lead us off.
Yeah, I think it's also important to note too that a lot of the regulation talk we've talked about here is we've been the SEC, CFTC is the U.S. versus crypto is a global phenomenon. So it's important to note that whatever U.S. specific regulators, which obviously impacts us more specifically, end up doing, and hopefully it's with an approach of education versus kind of squashing innovation. Crypto will survive. Innovation and smart people and kind of that human capital that's pushing along this whole industry will just kind of move elsewhere. So as a proud American citizen, I hope that it stays within the U.S. But at the end of the day, if the SEC or some other regulatory body, which as a firm we are governed as an SEC broker as well as a CFTC swap dealer, so it's something that's top of mind for us. But it will just push people away versus kind of squash innovation directly. And then just kind of tying back to your question about pulling in more people to this space. I think one, we saw a big, I'm not a proponent of NFTs, but NFTs and things that people can relate to very easily is kind of how you get that initial conversation started. And then it's kind of like a amusement park of like financial innovation where you can kind of explore things that interest you and you find what sticks.
Nico?
Yeah, so I don't think DeFi is meant for the masses, so to speak. I don't think in 20 years everyone's going to be logging into Aave and posting their house as collateral and borrowing against it every day. I think it's going to be more so we'll have a series of front ends that people can interact with. It's going to end up being a regulated front end eventually, where it's very similar to like your Charles Schwab or your Robinhood account, where it's easy. You don't have to worry about custody. You don't have to worry about security. It's basically just you're interacting through an intermediary is how you get more people into DeFi. But I don't think it should be something that everyone should be using. People have financial advisors for a reason. People have someone to manage their money for a reason. Most people are bad at it. So I don't think it's meant for the masses, but I do think there is a massive amount of capital that can flow in through these intermediaries and through these front ends eventually.
Yeah, that makes a lot of sense.
I would agree that there's probably a big opportunity to onboard people through good front ends and good UX. I would say I hope that that's not the way that DeFi ends up going for everybody, because part of what makes crypto is that you actually own the positions that are in your wallet. And if everything ends up happening through a regulated front end, you might as well just put things in a centralized ledger, and you'll save a lot of energy and everybody's time doing it that way. And ultimately, if you force everybody through a regulated front ends, that's basically what you're doing. And then I would also push back a little bit on the idea that if the US isn't on board with DeFi, it's going to continue existing and do fine. I think that the way that DeFi grows next is it has to get institutional adoption. And in order to get institutional adoption, the US has to be on board with it, because there's no global financial institution that's going to try and go against the US government. You might have some large hedge funds in Singapore, maybe some like funds in China, although China's already like trying to take control of it because it's a threat to their power, because they're fixing their currency's price and doing a lot of manipulation of their own. But if the US government bans it, I think it's really pretty bleak for DeFi, and like we have to succeed here or it will affect the rest of the world.
So I see DeFi as the base layer of all crypto. I mean, it's just like any market works, right? Your market's only as strong as your liquidity or how money circulates through the system. So, I see DeFi being extremely prevalent in the NFT space, in real estate, in insurance, and in just sort of every single facet that you can possibly imagine. So, Ryan, my question to you is, where does DeFi go from here? How does DeFi keep growing and evolving?
Yeah, so just to kind of also reflect on some of the things the guys said, a lot of interesting thoughts. I think, we've been hearing this idea that institutions are coming, and like when we talk about big pension funds and things like that, like I hate to break it to you guys, but it's a long way off, right? Like these folks can't own gold. They all know what gold is. They understand it. They don't have to explain it to the investment committee, but the problem with highly volatile assets is like there's no accounting favorability. You get mark to market. It's the most, you ought to be a hedge fund to be doing it because it's a really vicious accounting process. And so to me, it really doesn't make sense to expect institutions to come in anytime soon, except through, investing in vehicles like hedge funds and like, other investments like that. I really think the path forward is through different retail products. I think there's a ton of hurdles there, right? But like, if we really get down to what's perhaps most important about DeFi, I think it's really this idea of permissionlessness, which is a really specific kind of twist on that idea of trustlessness, where it's like, if you look at every other financial institution that's ever existed, every financial system up until now, it's been gated in a sense where you have to go and you have to get permissioned into the system, right? And so the one really important thing about DeFi is that anybody with a wallet can interact with this system and gets access to these financial products and services. And so when we're talking about the United States, incredibly important from a regulatory standpoint, but for a lot of us, it's not super compelling because we have a functional financial market around us. But when you look at the global south, when you look at countries like Argentina, where their pesos inflating like 50% a year, stable coins matter a lot to them. And they matter a lot to like the regular people just trying to go out and buy things and survive. And so I think when we look at stuff like NFTs, that's really interesting because it got people into DeFi without just diving into like these complex structured products. And I think it's also more of that and then more of abstracting the experience so folks everywhere can get into it. Because I think the growth is really going to come from the global south, places that really need, financial equality and equity with the rest of the world and have lacked that up to this point. I think without that, it's like if we do just have a permission system, like I think we threw the baby out with the bathwater. If we took this thing like Bitcoin and Ethereum that was totally decentralized and then it's just custodied by Fidelity and Schwab and, we just rebuilt traditional finance on new rails. And I don't know if that's really what we should be striving for as an ideal in DeFi.
That's a great point. So I think we've gotten to the point where we have time for maybe 2 questions from anyone in the audience. Anyone interested in asking a question to one of our panelists? Over here.
Yeah, just wanted to ask you your opinions about the whole Luna fiasco and USD, and wanted to see what you guys are doing to kind of, go through that or not.
Yeah, I can talk about this one a little bit. So our background at Edge is traditional finance. Our CIO comes from a large macro fund background, and so he took one look at the system and he compared it to like a lot of sovereign debt crises that have happened over the past 20 years where you have outflows that are higher than inflows, right? So you're eventually going to get to a point where you can't pay people out anymore. And so he compared this to like Lebanon in, I want to say the like 90s or early 2000s, not a macro guy, but just looking at that and then looking at the reflexivity of the Luna coin, right? Everybody saw how quickly Luna went from 52, and then when they raised $1 billion for LFG, it was $110 shortly thereafter. So things are it can go up really quickly, it can go down way faster. Everybody kind of knew Luna was kind of doomed from the start, but I really think what the kind of final nail in the coffin for them was they just got way too big, way too quickly, right? So you could have large traditional institutions step in and essentially break it. I think that's kind of the general thought as to what happened there, but I'm interested in what these guys have to say about it.
Well, unfortunately, we're just out of time here, but thank you so much for your question. Thank you guys for your participation, your engagement. Thanks for sharing the stage with you guys. It's been a pleasure.